Welcome to this explainer. Today, we're going to demystify exactly what 3.5% monthly credit card interest actually looks like. I mean, we hear these numbers thrown around all the time, right? But theory is one thing, and reality, well, that's an entirely different beast. So instead of just dryly talking about percentages like a textbook, we're going to dive into 5 specific, real-world case studies to see how these numbers actually play out in everyday life.
Okay, we're going to break this down through 5 distinct scenarios. The small balance trap, the minimum due disaster, revolving instead of EMI, the cash advance catastrophe, and finally, a rewards reality check. Let's jump right in.
Scenario number 1, the small balance trap, or, as I like to call it, Rahul's 2,000 rupee mistake. So Rahul makes what seems like a totally innocent choice on his Axis Atlas card, but it results in a massively outsized financial penalty. He had a bill for 42,000 rupees, and he decides to pay 40,000. He intentionally leaves a quote-unquote tiny 2,000 rupees unpaid, figuring, he'll just settle it next month. No big deal, right? But here is the absolutely critical mechanism at play. By leaving just that tiny fraction of his bill unpaid, Rahul completely lost his interest-free grace period. This means that all of his new monthly charges, let's say 25,000 rupees of fresh spending, instantly started generating interest from day one.
And here's the ultimate irony of that decision. Rahul was trying to save 2,000 rupees in immediate cash outflow. But because he lost that grace period, he got hit with interest on both the remaining 2,000 rupees and his new 25,000 rupees of spending. His little savings hack literally cost him 2,101 rupees in finance charges. That's more than the amount he held back in the first place. Moving on to scenario 2. We call this the minimum due disaster, featuring Priya's medical bill.
So Priya had to use her ICICI card for a 75,000 rupee family medical emergency. To manage the expense, she decides to just pay the 5% minimum due for 3 consecutive months. Guys, this is the ultimate trap. Look at how Priya diligently pays 3,750 rupees every single cycle, yet her balance in that final column, it is barely dropping. The interest charged each month is practically wiping out her entire payment.
Let's track exactly where Priya's hard-earned money actually went over those 3 months. Out of the 11,250 rupees she paid out of pocket, a massive chunk, 7,756 rupees, was just instantly vaporized by interest. Her actual debt was reduced by a measly 3,494 rupees. The takeaway here is absolutely crucial. The minimum payment is a false safety net. When she finally paid off the full remaining balance in month 4, Priya had shelled out 82,756 rupees for 75,000 rupees of spending. Just paying the minimum due cost her thousands of extra rupees for absolutely no reason. All right, scenario 3, revolving instead of EMI. Let's look at Vikram's new laptop. Take Vikram. He had an 85,000 rupee balance on his SBI card for a laptop, and he wanted to clear it over 6 months. He chose to manually revolve his debt, paying off a pretty hefty 18,000 rupees month by month. And hey, he successfully cleared it. But by revolving at the standard credit card rate, that total interest accumulation over 6 months quietly snowballed to 9,584 rupees. Now, compare that manual approach to a formal EMI. If Vikram had simply clicked a button in his app to convert that 85,000 rupee balance to a 14% bank EMI for 6 months, his total interest and fees would have been just 3,795 rupees. It's the exact same underlying debt, the exact same timeline, but manually revolving it cost him an extra 5,789 rupees. Okay, buckle up for scenario 4, the cash advance catastrophe. This is Deepak's urgent need for cash. Deepak needed physical cash fast, so he withdrew 30,000 rupees from an ATM using his HDFC credit card. Let me tell you, taking a cash advance in India is brutally expensive. First off, there is 0 grace period. The interest clock starts ticking the literal second the cash leaves the machine. Second, interest rates hover around an eye-watering 3.5 to 3.75% per month. And third, you get hit with an immediate 2.5% cash advance fee, plus GST right on top of that. Because all these fees just stack on top of each other, borrowing 30,000 rupees for a mere 25 days, meaning he paid it back by his very next billing cycle, cost Deepak 1,760 rupees. When you actually run the math on that, it unlocks a jaw-dropping effective annualized cost of 85.8%. Just contrast that with taking a standard personal loan from the exact same bank. A personal loan might run you maybe 12 to 15% per annum, right? Deepak paid over 85% to borrow from his own credit card. This clearly proves that withdrawing cash from a credit card is hands down one of the most dangerous, wealth-destroying financial moves you can possibly make. You are almost always better off taking a personal loan or just borrowing from family. Finally, we arrive at scenario 5, the rewards reality check. Let's talk about Mira's cashback trap. This one goes out to everyone who thinks they are completely outsmarting the system with points and cashback. So Mira has an SBI cashback card. She spends 40,000 rupees online every month, earning a fantastic 5% cashback. That is 2,000 rupees right in her pocket every month. She feels, and quite understandably, like she is absolutely winning the rewards game. But here's the catch. Mira is completely ignoring the 20,000 rupee revolving balance she also carries on that exact same card. And this reveals the invisible drain happening in her finances. Yes, she's earning 2,000 rupees in rewards, but 826 rupees of that is silently eaten alive by interest and GST on her revolving balance every single month. Because her net benefit is technically still positive, she thinks she's ahead. But that interest drain remains entirely invisible as long as she's only focused on the earnings column. I love this quote because it hits the nail right on the head for Mira's situation. What she doesn't realize is that her cashback is actually capped at 2,000 rupees a month. So if she spends more, she earns absolutely nothing extra. Meanwhile, because she's carrying that 20,000 rupee balance, she is essentially financing a chunk of her everyday spending at over 40% per annum. Her revolving balance is dramatically eroding the true value of those rewards she's hustling so hard to accumulate. The rewards she celebrates and the interest she ignores live right there on the exact same monthly statement.
So as we wrap up this explainer, I want you to ask yourself a pretty hard question. The compounding nature of credit card debt is designed from the ground up to be highly profitable for banks and highly punitive for consumers who revolve the balance. Take a close look at your own statements. Factor in those lost grace periods, crunch the numbers on your minimum dues, and ask yourself honestly, are your rewards earning less than you believe? Stay informed, stay focused, and I'll catch you in the next explainer.